You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday once again here on the old network. Time for everyone's favorite educational program. It's time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And, of course, you guys can get this show. Most of you get it on demand. I get it. You like it on your platform of choice. There's more platforms than ever. There are literally more hitting us up every week. I don't understand how we not hit peak podcast platform yet, but apparently we have not. There are more platforms, more communities, more spaces all around podcasting, which is a good thing at the end of the day. More ways for you guys to get the shows. It's just amazing that there are so many. So you guys have your choice of on-demand places to get the show. If you want to go above and beyond, join us live during the show. Ask us questions, not just for this show, but for everything else we do here on the network. And, of course, join us for an exclusive Options Pro Q&A sessions every Tuesday, Options Oddities every Friday. You get another fun exclusive this week. All of our pro members get a double dose of Options Bootcamp. Today, you get to hear the second episode now. We're recording that ahead of time for the holiday so Dan can go eat turkey in peace next week. But, yeah, you guys will have to wait till next week to hear that one. If you're listening live today, you get to hear it. So all the fun stuff that goes on over there in the land of the pro, of course, I'm staring at a just mountain of items from throughout the world of options that we have amassed over our nigh on 15 years in this business. And what are we doing with them? We're sending them out to you folks in the pro with our pro trading crate. We just sent out a bunch of pro trading crates. We're going to have more to go. We give one away every month out there. It's fun to all of our pro members. Just an extra fun bonus we like to do. Why? Because we like you. So head on over to theoptionsinsider.com/pro. That's the place to go to begin your journey to the dark side over there. It's a fun place. I like it. Fun community, nice people, and you get to ask fun questions. What more can you possibly ask for? Let's go on out to the hinterlands of Chicago, way out there down south, almost on the border of Indiana. Not quite, but pretty close, where we are joined by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call Mr. P, welcome back to Options Bootcamp, sir. How were your travels hither and yon?
Oh, they were good. I haven't traveled like this for a couple of years, but then, you come back and you got to catch up for 3 days, but I'm getting there. I'm getting unburied.
All right. Well, before we kick off our stuff today, I think the folks out there want to know, we do need a theme song for this segment. They want to know, Dan, what's your rating?
Oh, man. There have been a few options raters stuff popping up. One that came up the last couple of days was Prog, P-R-O-G, which just freaking killed it. So that one's a really nice one. Check that out for those of you folks who like checking these sort of things out.
What was that ticker again?
P-R-O-G.
Prog. Here we go. A fun one out there. Are you buying cheapy calls this one again? You buying a 50-cent calls on a $3 stock again, sir?
I was buying 55-cent calls on a $4 stock, man.
The wonderful world of rating. 2021, we used to mock such things, and yet here we are. This is the world we all live in, into the land of 2021. And so let's kick it off out here with some options drills.
Hell in boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody. Welcome to the options drills, like the man said. This is where we explore some specific strategy, or in this case, strategies, and explain how you can utilize them to achieve very specific objectives. And these days, Dan, it seems like everybody and their mother and their father and their grandmother, everybody else is piling into options. We talked about this. It's been, the post-pandemic surge. The data is coming out. We're seeing articles now in Bloomberg and others, the mainstream media catching on to the options frenzy, talking about how everyone, particularly in the smaller one-lot retail type crowd, are just piling into upside in all of these tech-heavy names, these meme names, and are changing the way options trade and perform as a result. Bloomberg having a big article recently about how it's starting to almost decouple the VIX in a way from what you usually see. Usually we see these kind of bids and these firm levels and volatility in VIX, and the fact that it won't go below, let's say, in this case, 15 these days. Usually that's because of the bid in the puts out there in the S&P, but people are loading up on calls in a lot of these tech-heavy names. As a result, that's where a lot of this firmness and volatility is coming from right now. Firms like Susquehanna are just living for this. They're mining the data like crazy and showing just how crazy the upside frenzy is these days. So we know a lot of you have upside on the brain these days. So we thought for this episode, heading into the holiday, we would explore some ways you can express that upside outlook, that upside optimism in a stock. Dare I say it, your FOMO, and not get your face ripped off, hopefully, in the process. So, Dan, what do you think? Sounds like a good pre-holiday bit of options drilling, sir?
Yeah, this sounds like a pretty stellar plan, man. I'm looking forward to today.
All right, let's kick things off with the most basic of them all. Also, these days, seems like the most popular trade on the planet. It is your basic long call. All right, so what are we doing here? Let's go back to everyone's favorite name, XYZ. XYZ. We've all made and lost fortunes in XYZ. And XYZ, for our example, going to be trading $50. You're coming in. It's a hot meme name. Let's say it's a little rich for a meme name, but let's just go. It's a hot meme name. You think the thing's going to pop? It's going to pop over the course of the next month. You have serious FOMO. You don't want to miss out. You want to get in while the getting is good. So you look at it, you say, I think this thing could pop 10% in a month. I'm going to come in and I'm going to buy the 55 call. In our example, that call is not cheap. You're going to pay $1 for that call. So obviously every one lot is 100 shares, a multiplier of 100. So every one lot is going to cost you $100. Now fast forward maybe to next year with the nanos, and then every contract's going to be 1 share. So a very different beast. Every one lot's going to cost you $1. It's going to be a weird world when those come online, but we have a little bit of time before then. Till then, it's still talking 100 multiplier for most things. Obviously, in the textbook P&L graph definition, which we're not huge fans of here on the show because it's very limited. But in that textbook P&L graph, you look at the chart, it says, okay, the stock has to rally to 56 by expiration for you to break even. And technically that is correct. The stock does need to close on expiration at 56 or higher. Remember, 55 strike plus the $1 that you paid, and that is your break even. So if you think this thing can move aggressively over the course of that time frame, then loading up on a call, not the worst way to go. We don't always cast it in the best light here on the network. We don't say, hey, loading up on upside is the savviest of trades. That's because usually it isn't. Because as we've said many times on this network, it does take a pretty aggressive and very early pop for these types of trades to pay off. It doesn't mean it's always the bad choice. Sometimes buying a call is the optimal choice out there. So we say the theoretical definition, the P&L definition. Practically, in the real world, what happens when you buy these calls? A bunch of things. But in reality, as we said before, and we'll say it again, when you're buying premium in any direction, puts or calls, doesn't matter. What you typically need is that move to happen quickly and aggressively. You can't really have in this case, a long, slow, languid move to the upside where you gently drift, because guess what? You're pretty much going to go out worthless on this trade. What you need is an aggressive pop, let's say to 52 or maybe even 53, sometime early. This is a 1 month option. So you want this to happen ideally in the first week, maybe week and a half, because what do you have working against you? You have time decay. You have all these other factors. You bought an out of the money option. So there is no intrinsic value. There is no meat on this bone. It is all extrinsic value. It is all premium. So it can all go the way of the dodo if you don't get that move and get it pretty quickly. So if you don't get it within a week, or dare I say it two, by end of 2 weeks, of course, your option is going to be cut not quite in half. That's not exactly how time decay works, but pretty close to it. So what you're going to see effectively is now your option is worth 50 cents. So what you ideally want in this scenario is an aggressive pop in the first week to week and a half. And if you get that pop to 52, 53, forget that break-even diagram 56. If this thing pops aggressively to 52 and change in the first week or week and a half, you'll be able to take this call off for a profit. So that's the reality when you're dealing with these calls. And the other side of that, if you don't get that aggressive move pretty early, it might behoove you to start thinking about taking this off. You don't want to ride this all the way to expirations. People put on these calls and think they have a full month swing for the fences. You kind of do, but you really kind of don't. You really got a first half of that options life or so before you really need to start thinking about, hey, I'm getting hit by time decay. Do I want to let all this money go to zero? Or do I want to keep some to live to fight another day? So Dan, let's start there. Your use cases for long calls, when you like to use them, and perhaps when you don't, and also maybe any pro tips you want to layer in there for the folks out there who have the serious FOMO right now, Dan.
Yeah, I mean, you touched on it really well, man. With long calls, it's always a race against time, and the best traders measure that out. They use the Greeks and they say, hey, look, I own this call at, we'll just say XYZ 55 here. And I think the stock, can get up to $60 over the next 2 weeks. Okay, so let's look at that and let's look at what the delta is and how much I would make on delta. And let's also look at what the theta is and see how much I'll lose based on theta. And like that to me is really what every trader has to do. And that's going to help you in your expectations, but it's also going to help you in trade management. Not trade management, but trade selection. Because do I want to buy the 2 week call and have all the time decay gone, even if it works out, even if it gets up to 60, I still end up losing because all the theta ate up all the delta profits? Or do I buy like a month call or a 6 week call? I always look at this delta and theta balance. And so, we can use long calls for anything. Any bullish directional move. One of the biggest use cases that I have, as we all know lately, is options rater, where, I'm looking for a really big move in a really short period of time. Like that is the ideal scenario for anybody who buys a call. So, yeah. So, that's my biggest use case lately for them.
Yeah, you're doing this right now. You're loading up on out of the money calls all the time these days. Speaking of out of the money versus like at the money, Dan, because that's a question we get a lot these days as well. Hey, people usually load up on out of the money because A, they're cheaper. B, they think there's an upside to come so they can get a little bit more bang for the buck, they think, if they can go up there. But if you migrate, let's say, down to at the money, maybe in our example, it's going to be more expensive. It's going to be probably at least $2, maybe $2.50. So that's a lot more expensive than the $1. Dan, when do you think about at the money, and dare I say it, perhaps even in the money? When do you flip that script, sir?
Well, most of the time I'm looking at out of the money calls just because they are cheaper, and because if you're right and the stock goes up through the strike price, you get the benefit of gamma and they become in the money calls. It's kind of the best of both worlds. So, you're paying small theta if you're wrong, and you're benefiting from gamma if you're right.
Yeah, the use case for at the money is a little bit different. Obviously, you're getting a lot more bang for your buck there. But also, as Dan said, at the money strike, that's where the decay comes out the hardest. So if you're loading up an at the money, that's why we always say at the money straddles are such a difficult road to go down, because you have two options that are decaying very rapidly, more rapid than anything else on the chain. And so if you're buying at the money call, it's going to cost you a lot more. You get more, you're going to get a little bit more skin in that game. But of course, flip side of that is that decay is going to hit you even more aggressively. And also with at the money, same deal as without the money. Really, you don't have any intrinsic value. Maybe if it ticks in, you have a few cents, but effectively, you don't really have any intrinsic value. So you still can lose all of that premium to time decay, and it's going to decay even faster there at the money. Something to keep in mind if you're going at the money. And in the money call is really not a thing a lot of people use. When you're doing it, obviously you're buying much more deltas, much more exposure. It's going to be much more expensive. Also, you have intrinsic value, which is nice. If you don't know what that means, listeners, go check out our archives of this show, or you can look it up online. It's all there as well. But you'll have some intrinsic value. The nice thing about that, it's going to cost you money. You're going to pay for that intrinsic value. But the nice thing about that is it won't decay. That cannot decay. That's actual value that you are purchasing there. So obviously it depends how much intrinsic value you get, how deep in the money you go. Typically the use case for an in the money call is going to be along the lines of a stock substitution type strategy. You have some long underlying you have right now. Maybe you're thinking about maybe taking that off and maybe swapping it out with a call instead. So you can take some of that money off the board, live to fight another day, maybe use it to trade something else, but still keep your upside exposure in that name. But also you're limiting that exposure if you're just buying that call. You're not going to ride that all the way down to zero. All you have at risk now is the price you paid for those calls. So that's a very popular use case for the in the money call, which is stock substitution. Again, if you don't know what that is, check out our archives as well. We have many episodes about that. Our buddy Brian, who's coming up live later today, you'll be able to hear him there on the huddle. I'll be huddling up with him. He loves taking those in the money calls and then writing an out of the money, effectively quasi covered call against it. He calls it the fig leaf. So check that out, Options Playbook Radio, if you think that's an interesting idea for a way to maybe tweak your covered call, make it a little bit more capital efficient out there. So that's a basic overview right now of what is the most popular trade in the game, which is the long out of the money FOMO call trade. Everyone's doing it. Things to think about when you're loading up on these out of money trades. You might think you have a month or whatever your time frame is. Maybe you're loading up in the weeklies. So maybe if you load up the weeklies, then you really have a couple of days, right? If you buy a weekly call, you don't have till weekly expiration for this thing to work out for you. I mean, technically you legally do, but in reality, practically, you need that pop to happen in a couple of days. If it doesn't, then you probably want to start thinking about closing it out, rolling, saving some of that premium to live to fight another day. Maybe you roll out another week, do whatever it is you think, but you should have that set up at the outset. If you're buying a call for, in our case, it was $1. You should have in the back of your mind, maybe if it decays, if I lose 30% on this, goes down to 70 cents, I'm going to close it out. Maybe I'm going to roll it. I'm going to live to fight another day. You should have that set up at the outset so you don't get any surprises in this. And of course, on the upside, if you get that big move, you should also know where you want to take it off, somewhere in that range. At least start scaling out at a certain level there. So I get it. People want to swing for the fences. And, in a lot of these names lately, it has been working. So you may think we're trying to throw cold water on here. We're just trying to explain how these things work in most normal scenarios. And again, we're not in anything normal. Now, the next leg beyond the traditional long call, you think, I like buying these long calls, but, they're pretty expensive, especially now. Call skew is bid up across the board, thanks to all you FOMO traders out there. So you may want to take that up a notch and maybe go vertical. So let's go to an example of that one again. XYZ. Same price level, $50, everything else kind of staying the same. You think the stock's going to rally again over the next month, so you want to buy a 1 month call. In this case, you're going to the same strike. You're going 10% out of the money. You're going to the 55, the double strike. You're going to pay $1 for it, same thing as last time. Now you say, you spend $1. That's a lot. It's $100 for every one lot. That's a lot of outlay. I don't think I want to spend that. But you still think there's an upside pop. You don't think realistically this stock's going to rally that much, let's say beyond 60. Over the course of this next month. So you say, you know what? I'm going to sell that 60 call against it now. And for our example, you still get some decent money for that. You get 40 cents. So now instead of paying $1 for the 55 call, you bought the 55 call for $1. You sold the 60 call against it for 40 cents. Your net outlay is now 60 cents. So you've cut your outlay nearly in half in our example here. So you can see the obvious benefit of doing that off the bat. Your outlay is much less. So if you're trying to take a lot of these swings at the fences there, sometimes it's expensive to have all your chips across the board. You go to the roulette wheel, a craps table, whatever you're preferred gambling analogy is. You start covering a lot of spots on the table, that gets pretty expensive. The same thing with call options. If you start buying calls in a bunch of different names you think are going to pop, that gets pretty expensive. If you want to be able to extend yourself a little bit farther, maybe looking at verticals instead, that will take some of that money off the table. You can use it for other trades or whatever floats your boat out there. So now you spent 60 cents. You have a 55.60, so a $5 wide call vertical. Of course, the P&L graph out there, the technical definition is going to tell you if that stock closes at $60 or above, you will collect that your max profit on that trade, which is the max value of the spread, which is $5 minus what you paid for it, which in our case was 60 cents. So your max profit on this is $4.40. Not bad for a 60-cent outlay. But, the reality is something similar to what we were talking about before. If this thing pops aggressively in the near term, let's say the first week to 2 weeks, maybe a week and a half in that range, let's say 52, 53 again, you're going to make some money on that spread because you're closer to the at the money, I should say, call out there is going to gain. Now, of course, you have another leg against it now. So that's the other downside of this spread is that that's also going to gain in value, the leg that you're short. So you're not going to make as much money on a spread as you would if you had the call outright. Just ask anybody who's been trading spreads of late. We get this question all the time. Man, I bought this spread, the stock popped, and I didn't really make as much as I thought. And that's because your spread has two legs to it, and your spread has a delta. Remember, you're buying one call that's out of the money, selling another one out of the money against it. So your net delta on that spread is the difference between those two deltas. So you can use that as a good rough ballpark estimate of how much you're going to make when the stock rallies. And it's not going to be as much as if you had that call outright. So something to bear in mind. There's no free lunch in options. You're getting a dramatically reduced outlay, but the return on that is going to be a little bit clipped as well. Dan, what are your thoughts on verticals versus outright calls to the upside, and when do you start slinging into a vertical versus a call, sir?
There's a couple use cases for it. One of the use cases is, first of all, if there is a whole bunch of skew to the upside, the upside calls are really bid up, and the higher the strike, the higher the vol, then it becomes bare minimum a hedge, because instead of buying really expensive vol, you're both buying it and selling it. But if you can sell a higher vol call than the lower strike one that you're buying, you're actually locking in that spread for a little bit of edge. So there's one reason, one use case. And the other thing is like one of the other trades that we do is called the red knockout, which is a momentum-based trading strategy. It works really great. We buy when it triggers, when it shows up on our scanner, we just buy the 45 delta call that has more than 15 days to expiration. But when it pops up on something like Amazon or Google, where it's $1,000-something stock, the options are just too expensive for people with a small account. And so then you kind of have to use a debit spread because the option you're selling offsets the cost of the option you're buying.
Speaking of offsetting things, if you want to go above and beyond, listeners, the vertical is kind of your first basic step. Many of you then graduate to another trade, which is extremly popular. If you're in our pro chat and you heard Tony Sliwa we had on a few weeks ago, huge fan of our next strategy. A lot of pro traders end up graduating towards this strategy for a variety of reasons. It's kind of the next step beyond the straight vertical. It is the butterfly. We have talked about this before. I got a feeling, given the inquiries we're getting about this, we're probably going to talk about it again. It's a very interesting, very multi-use strategy. So in our example here, back to XYZ, trading $50. Now you think, again, it's going to pop over the next month. So you're going to buy that 55 call again for $1. Same exact outlay. Again, you think it could make it to 60, but really not that far beyond it. So you're going to turn around. You don't want to have all that outlay. So you're going to sell that 60 call again. Remember, it was 40 cents. In our previous example, we just sold one. It was a vertical. Now we're going to sell two. We're going to sell twice as many as we bought. So instead of collecting 40 cents, we're going to collect 80. So now you see your outlay. $1 minus 80, it's down to 20 cents. But you're saying to me, Mark, but wait a minute. Don't you always say, don't be net short units? I'm net short units there. I have a naked short leg. They're going to margin the hell out of me on that. And you're right, they will. So what you want to do is to prevent your face from getting ripped off. And we've all seen this could happen over the course of this past year. You're going to buy another leg against it, hence the butterfly. You're going to go another $5 past it. So you're going to have a nice standard symmetrical $5 wide on each wing butterfly there. You're going to buy the 65 calls. Only going to buy one of those. You only need to buy one. Remember, you bought one, then sold two. So you're net short one still. So you only need to buy one. You don't have to buy two. If you buy two, that's a different trade entirely. So you're only going to buy one of these 65 calls. And in our example, they're only trading for 10 cents. So they're not that expensive. So now your outlay is what? You spend $1. You bought one, you sold two, so you collected 80 cents, you're down to 20 cent outlay, and then you spent 10 more cents. So your net outlay for this trade is 30 cents. You not say, wow, 30 cents, that's a hell of a lot better than $1. And you're right, it is. So that's the first thing that lures a lot of people to butterflies. You could trade a lot of them for not much outlay. And so instead of going out and buying all these calls, 10% out of the money for $1 here, there, and everywhere, you're going to run out of capital pretty quick. You start doing flies instead, you can obviously do a lot more. So that's the first thing that attracts people is the outlay to it. Now, the theoretical portion, what you're going to see if you look it up online or go to an educational platform, look at the P&L graph, you're going to see you sold 2 of the 60 calls in our example. So that's where you want the underlying to settle at expiration. Pretty much any spread listeners, we have a short leg somewhere. That's usually where you want the stock to go out. You want it to go out right where you're short. Why? Because it's going to maximize your decay. You're going to get that decay to kick in nice and fast. You want it to settle out exactly at $60 in this scenario. That would be ideal. And then what happens there, you get the value of that spread, which is $5 wide, essentially butterfly listeners, 55 to 60. And then, of course, you have the second leg against it, 60 to 65. But it's net $5 you can make there. You paid 30 cents for it in this example. And you can make the most is $5 on that $5 spread. So now you're going up to $4.70. Not bad. Of course, the practical side, and this is where we get a lot of questions, and this is where we can and probably will in the future do an episode, maybe 2, on just how to deal with butterflies, how to take them off. That's where a lot of the rubber meets the road with butterflies. But the truth is, if you start getting a pop into, let's say, that 52, 53 range, like we talked about before, you will probably be able to take this off for some. I use some profit. The downside is, remember, you're short 2 of the farther out of the money legs, and those are also going to gain in value. So whatever they gain, you're losing 2 of, effectively. So that's where the challenge of butterflies kick in. And you're not going to make a ton on that way, way out of the money call usually. So that's not really going to kick in much to help you. So the notion you could just take this thing off for double your money very quickly, probably not going to happen. So an aggressive move of the butterfly is actually kind of not what you want. If you explode right to that 60 strike, those 60 calls are going to explode as well. And that's a challenge for it. So what you want in this is actually a little bit different. You would like a nice, maybe meandering move to that 60 strike and just settle right there. That would be ideal for a butterfly. As everyone who's traded flies, and we've heard it from a lot of you recently, if you get that move too quickly with the fly, you need time for that decay to come out of those short legs. In this case, the 60 calls. And no matter what happens, that has to happen. So if you get that big move right away, you're not going to have your max profit on the fly. You're going to have to sit and wait for that decay to come out of the 60 calls. And that's where people get really frustrated. And that's the big challenge with flies. Dan, what are your thoughts? A, overalls on butterfly? Overalls, listen to me. What are your thoughts overall on butterflies? Do you like them? Do you not like them? B, when do you use a butterfly versus, let's say, vertical or a traditional call? And then C, where the rubber really meets the road, how do you like to take them off, sir?
Well, I usually trade butterflies when I'm in my overalls. I guess timing's everything.
Yes.
Never mind. Can we have somebody edit that together so I sound funny?
So it sounds much better. Yes, our editors will work on your comedic timing for you.
So as far as butterflies go, to me, there are a couple of really important things to consider. One is, to me, the real value of it is you can put so much less into a trade and have an extremely highly leveraged profit. Because you're basically, like, if you think of call debit spread as the short call finances the long call, you can think of a butterfly as the short credit spread finances the long debit spread. So you're just really increasing leverage from taking in so much premium. And I like to use them directionally. In fact, John who works with us, he's our head coach. He loves doing them directionally because, if you bet 30 cents and you can make $1.70, great. Now that brings me to my second point. You're not going to make $1.70. The thing with it is like the stock is never going to be right at the strike price. Now I say that it will sometimes, but it almost never will. And you should assume that it's not going to be. You just want to capture sort of that center area if you're looking at the P&L diagram. You want to make a pretty good profit. Some of these where you can get 5 times leverage, if you can make 150%, you did freaking great, especially if you're using just a little bit of capital. As far as taking them off, most of the time I like to take them off in one fell swoop, but sometimes I'll get a little fancy and leg out of either the credit spread or the debit spread. When I can, when I can take it off for the lion's share of the profit and then just ride out the other side.
Yeah, there are many moving parts to it, as you mentioned, the debit spread and the credit spread, and how you take a fly off can be just as important as your strike selection and when you put it on. I'll give you a good example, Dan, really quickly about timing and how important it is. This is kind of the other side of it. The move didn't happen too early. It happened one day too late. Remember, someone asked on our last show about if we were trading BIDO options. I said I put on, I think it was a 40, 43, 47 vertical in the BIDO, which is, of course, the Bitcoin ETF. Do you recall that, Dan?
Yeah.
Well, that was expiring on Friday the 5th. So back in our last show there. And BIDO went out on Friday the 5th, I think 39.80, something like that. So the fly was worthless, useless. Guess where it gapped to on Monday when Bitcoin rallied?
Where? I didn't notice.
42.78, I think, something along those lines. It was almost exactly at my short 43 strike. So literally, listeners, one session later, that fly that was worthless would have been a pretty big home run. That's just kind of the way the cookie crumbles sometimes. So flies are challenging. In my case, I needed one more day. Sometimes you can get it the other way. You get the big move happens too early. And then you're left kind of holding the bag and twiddling your thumbs saying, man, what can I do? You can take off pieces of it, but it's still not ideal. We got Frank in the chat saying, I'm more of a fan of flies right now than verticals. Yeah, I'm with you. Flies are attractive for all the reasons we just laid out. We also got good old Unlimited there in the chat saying he's looking at your, Prague from earlier. And he says there's only a couple of strikes that are not in the money available. Yeah, that thing has moved quite a bit. Prague is trading around 512 right now. It's rallied quite a bit over the past month from $3, actually 2.5 to where it is right now, 512. So nice pop. And you're right, there aren't many strikes. There's, I think, the 7.5 strike and the 5.5 strike. That's what happens with these cheap stocks rally quite a bit. They don't add all the strikes yet. So you probably, if you hang around here, you probably see some more strikes coming in there. But getting back to wrapping this up, we'll have more of our live chat and more questions coming up in our next episode here. But getting back to kind of summarizing our topic for this week, everyone's got FOMO these days. How should you express it? There are 3 very common ways, most common ways people like to express it. The basic call. You get a lot of room to run. You get all the room to run to the upside. The downside is it's expensive and it's going to decay very quickly. So you really don't have all the time you think when you're buying a long call. You really only have a small fraction of that window before you really have to make some hard decisions and say, hey, I've lost 20-odd%, maybe 30-odd% of the value of this call to decay and no movement. I probably need to do something here. So bear that in mind. Some people don't want to hear that in this FOMO environment. They're going to buy the call. They're going to let it go out. And if it hits, it hits. If not, they try to fight another day. That's very expensive. So if you want to be more judicious about how you do it, that's something to consider when you're putting on your FOMO calls is have a plan in place. So you're going to take it off. Maybe you could roll it out another week, live to fight another week there and have some of that premium work for you. You don't just let it go away. Work for you to get another week out of it. You still get all that value. You still have to pay a little bit for the next one, but you can sell what you have and get that value out of it. So don't just let it go to zero. You make it work for you. Then, of course, you can go into verticals, get some of that outlay reduced. Of course, you're clipping your upside. In our example, instead of unlimited upside, we went to $5 worth of spread and you paid 60 cents for it. Yes. So your max profit was $4.40, but realistically in that time frame you're working with, that's probably the more reasonable way to go. Not every name is going to be a GameStop or an AMC, listeners, or even a Prague. So something to bear in mind. And of course, The more pro-level type trade is turning that into a butterfly, buying one, selling two, and then buying one against it. Usually they're done symmetrically. In our example, it was done symmetrically, $5 apart. So you bought the 55 call one time, you sold two of the 60 calls, and you bought one of the 65 calls. But you can play with that. You can play with where you set up those strikes. And as you start looking at the options chains and what the premiums are, you could make that determination. That fly I just told you about, the one I did in Bitto, was a bit of what they call a broken wing, where one of the legs is a little bit out of whack. It's not symmetrical. It was 40-43, and then I bought the 47 against it just because the upside was so expensive. That's the way I worked it out. I don't usually like to structure my flies that way. I don't like to have a little bit extra danger to the upside, but it just worked out. The outlay was negligible at that point by doing it. It was, again, a kind of a cheap roll of the dice there, and that's what flies can be. They're very cheap outlay, but bear in mind, there's a lot of moving parts to this, and it's very rare, as Dan said, it's very rare for the underlying to go out right exactly where you need it to. So you have to have a plan for when that doesn't happen, whether it happens too early or if it happens too late, what you're going to do in that. But flies are very attractive in this environment as well, where things are just, again, we're doing all this in this environment where calls are very bid up. So you could buy verticals and put on flies for very cheap levels, cheaper than you probably normally would. So that's why those latter types of strategies are much more popular now than perhaps they would normally be, because you can put them on for levels that are very attractive, and they make your overall potential for profitability, I should say, much higher as a result. Dan, any last minute things to say about FOMO upside trades? And then if folks want to hit you up about rating or anything else, where should they go? What should they do?
So, yeah, as far as FOMO, BLNK just showed up on Options Radar. I jumped into that puppy. That one looks like it's taken off right about now. But that being said, listen, if you want to reach us, you can always go over to markettaker.com and just hit the contact us. Let's help any way we can.
Give that ticker one more time again, sir. What was it?
BLNK.
BLNK. There you go. Check it out. A little bit of free rating advice there, listeners. And check him out, Market Taker Mentoring, if you want to learn more. MarketTaker.com. We got to get on out of here. But if you're listening live and you got questions, I see them. We're going to come right back at you with our special holiday mail call palooza. So stay tuned for that. If you're listening after the fact, you got to wait a week, but we'll be back at you next week with your holiday mail call. We'll see you then.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.